Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
Imagine running a company where for every dollar that comes in the door, you just keep like 82 cents as pure operating profit.
Yeah, it's almost unheard of.
Right. Like no factories, no complex physical supply chains to worry about, no shipping containers getting stuck at ports or anything like that. Today, we are pulling back the curtain on a 275-person team in the digital economy that is doing exactly that.
It's wild.
It really is. So welcome to today's deep dive. We are diving into the B2B iGaming sector for you today. It's this industry where, the scale of money moving around is just staggering, yet the companies actually powering the infrastructure, they're often completely invisible to you and to the average consumer.
Exactly. And the foundation for our analysis today is the Q1 2026 interim report for a company called Hacksaw AB.
Right.
They're a technology platform and a game developer. And honestly, looking at their financials provides this totally unfiltered look into how this hidden sector operates. I mean, the numbers they're putting up are an anomaly, even within the highly lucrative software world.
Okay, let's unpack this, because to really grasp what Hacksaw does before we get into those crazy numbers, I want you to kind of shift your perspective for a second. Don't think of Hacksaw as the casino. Think of them as the company manufacturing the digital slot machines, right? Wiring the building and constructing the very floor those machines sit on.
That's a great way to put it.
Yeah, and we are going to deconstruct how a company achieves that almost unheard of 82% profit margin. We'll look at how they're building what is essentially an app store ecosystem for gaming and what their specific blueprint for growth can teach you about modern digital scaling.
Right, because the mechanics of this business model are it's a masterclass in operational efficiency.
Totally.
We really have to start by looking at the sheer velocity of Hacksaw's recent growth. I mean, just in the first 3 months of 2026, their total revenue hit 57.6 million euros.
Wow.
Yeah, that is a 28% increase compared to the exact same period last year.
Which is, that's massive growth for a single quarter. But reading through the report, there's a metric underneath that top-line revenue that paints, I think, an even stronger picture of their core business. They mentioned something called a constant currency basis.
Yes, that is such a crucial detail.
Yeah.
Because, Hacksaw operates globally, which means they're dealing with multiple currencies all the time.
Right.
So if the euro suddenly dips in value compared to, say, the US dollar or the British pound, it makes their raw reported numbers look worse than they actually are, simply due to exchange rates.
Just noise in the data, basically.
Exactly, just Forex noise.
Yeah.
But when you strip away those fluctuating foreign exchange rates to look at the actual business, the real volume of people interacting with their software, their revenue growth was actually 37%.
Oh, wow. So the core engine is running even hotter than the headline number suggests?
Yeah, exactly.
And that brings us to the profit. Their profit for the period jumped an incredible 51% to 45.5 million euros. But, and this is the crazy part, it's their operating margin that is the real jaw-dropper here.
Oh, absolutely. They reported an adjusted operating profit, their EBIT, of 47.4 million euros. That translates to an adjusted operating margin of 82%. It is the defining metric of this entire document.
But how is an 82% margin even mechanically possible? If you're running a business in the physical world, like, I don't know, a grocery store, a manufacturing plant, a logistics company.
Oh, you're dealing with so much overhead.
Right. You're dealing with physical wear and tear, raw material costs, union negotiations, fuel prices. You might be thrilled with, a 10 or 15% margin?
If you're lucky, yeah.
Yeah. Even a traditional software as a service company is usually heavily burdened by massive customer acquisition costs and these huge, towering server bills.
Well, what's fascinating here is how their frictionless scalability translates directly to human capital. You look at a company generating roughly 210 million euros over the last 12 months, operating at an 82% margin, and you might naturally picture this sprawling corporate campus, with thousands of engineers.
Yeah, exactly.
But Hacksaw only has 278 employees. And when you adjust for part-time, it's actually 275 full-time equivalents.
That revenue per employee ratio is just absurd.
It really is. A relatively small team is generating this massive cash flow through extreme operational leverage. Because, code scales infinitely.
Right.
Once the core game or the platform architecture is written, deploying it to 100 casinos costs essentially the same as deploying it to just one.
It's just copy-paste,
Yeah,
basically.
pretty much. And because they are highly profitable, they are operating completely debt-free.
No debt at all.
Zero. There is zero interest-bearing debt on their balance sheet. Instead, they're sitting on 176 million euros in pure cash and cash equivalents.
And the CEO, Christopher Kjellberg, he specifically noted in his commentary that this revenue growth is entirely organic. Like, they aren't going out and buying up other companies just to artificially inflate their top-line revenue before an earnings report, which you see a lot.
All the time.
Yeah. They are building this in-house despite a high degree of what Kjellberg calls, quote, global macroeconomic uncertainty.
Right, which is, a very corporate way of acknowledging that global inflation, interest rates, and consumer spending are currently just a roller coaster.
Exactly.
Yet, their B2B model appears really heavily insulated from those consumer-level bumps. The casinos themselves take the hit on marketing and player retention. Hacksaw just sits back and collects on the infrastructure volume.
Hold on, though, because if they are relying entirely on a team of 275 people to build all this code, there has to be a ceiling, right?
You would think so.
I mean, 275 people can only develop so many games, debug so much software, and manage so many clients before you just hit a wall of burnout. So how do they maintain this growth without scaling their headcount to match?
Okay, so this is where we get to the core strategic shift that's outlined in the Q1 report. Hacksaw is not just a game studio anymore. They have deliberately transitioned into a platform. The report shows they released 27 new games in the first quarter alone. But the crucial detail here is that only 12 of those were fully developed in-house by Hacksaw's own creative team.
The other 15 were built by third-party studios.
Exactly.
They're using Hacksaw's platform, which is called OpenRGS.
Exactly. So more than half of their new releases this quarter came from outside developers. They now have 9 partner studios developing on this platform, including a company called Foxhound Games, which actually just launched its very first title in February.
So wait, why would Hacksaw do this? I mean, if they're sitting on an 82% profit margin for games they build themselves, why give up any of that margin to third-party studios? Aren't they just diluting their own brand and, sharing the pie?
It seems like that at first glance, but to understand why it's actually a brilliant move, we need to unpack what OpenRGS really is.
Okay.
RGS stands for Remote Gaming Server. Integrating a single new game into a massive casino operator's complex back-end software is an absolute nightmare.
Oh, I bet.
It requires deep technical work, constant security audits, and massive compliance checks. But Hacksaw has already done the agonizing work of integrating their RGS into hundreds of casinos globally.
So what does this all mean? The RGS basically acts like a universal adapter.
That is exactly it. A universal adapter, a small, independent, third-party studio like Foxhound. They write their game once, plug it into Hacksaw's RGS adapter, and suddenly that game is instantly available to be played on casino websites all over the world.
Wow.
And Hacksaw just takes a cut for providing those rails.
I mean, think of it like real estate, right? Hacksaw isn't just building the houses anymore. They've essentially become the zoning board and the utility company.
Exactly.
They laid the underground pipes, they connected the power grid, and now they're letting other studios take the financial and creative risk of actually building the houses on top of their infrastructure. It's the Apple App Store model applied to B2B gaming.
That's a perfect analogy. And the success of that platform strategy is highly visible in their portfolio metrics right now. By the end of March, their total portfolio had grown to 320 released games. But there's a specific metric regarding these games that reveals the true strength of this approach. It's their gross gaming revenue, or GGR.
Right.
The report notes that the top 10 games in their portfolio now contribute 43% of the total GGR.
And the critical context here for you listening is that last year, those top 10 games contributed 50% of the GGR. So the percentage of revenue coming from their biggest hits actually went down.
Yes, which is actually a deeply bullish signal for a platform.
Really?
Yeah, because in any creative industry, whether it's movies, music, video games, the greatest existential risk is becoming a one-hit wonder.
Oh, true.
If you rely on a single blockbuster title for half your revenue, you are incredibly vulnerable to shifting consumer tastes. What that drop from 50% to 43% tells us is that Hacksaw is successfully diversifying their risk.
I see. So the other 310 games in the portfolio are pulling more of their own weight. The burden isn't solely on the superstars anymore?
Precisely. The long tail of their 320-game portfolio is getting significantly stronger. And the data backs that up with another key figure. Their daily average number of rounds played over the last 12 months grew by 43%.
Wow.
That proves the sheer breadth of their catalog is engaging players, not just one or two viral hits.
That long tail is like the ultimate defensive moat, because if one game suddenly falls out of favor, the platform doesn't collapse because you have hundreds of others built by multiple different studios continuously generating revenue.
Right.
And that actually brings us to the next phase of their growth. Because, I mean, with infinite digital scalability and 176 million euros sitting in the bank, what does a tech platform do next?
Well, they leverage that massive cash pile to fund their own ecosystem and aggressively expand their territorial reach.
Naturally.
The Q1 commercial execution metrics show a relentless pace. They signed 79 deals in just 3 months, and 59 of those were brand new clients.
We really need to pause and think about the sheer friction of that number. These are not simple handshake agreements we're talking about here.
No, not at all.
We are talking about highly regulated, massive established names in the gambling industry. Bet365 in Pennsylvania, William Hill in Italy, Delaware, North, and West Virginia. Entering a new U.S. state isn't just, flipping a switch on an AWS server.
Oh, absolutely not.
Correct.
The U.S. market is notoriously complex because of state-by-state regulation. You're dealing with requirements that often mandate data must stay within state lines, requiring localized servers.
Right.
You have to undergo rigorous background checks for executives, deep technical audits of the software, and massive licensing fees. Yet Hacksaw secured an online gaming service provider license from the Connecticut Department of Consumer Protection in this exact same quarter.
Man. So when the report states they locked in dozens of deals and secured new state licenses in a 90-day window, that tells us their compliance engine is just as efficient as their coding engine.
Yes.
They've effectively productized the bureaucracy of expansion. But the commercial deals are only half of the flywheel equation here. The other half is what they are calling Hacksaw Ventures.
Yeah.
Here's where it gets really interesting. Because they have this massive 176 million euro cash pile, right?
Mm-hmm.
They aren't just letting these third-party studios use their OpenRGS platform to build games. They are acting as a strategic investor. They are actually using their cash to buy equity in the most promising early-stage companies within their own ecosystem.
This initiative just highlights the brilliance of their strategy. The report highlights a previous investment in a company called Kitsune Studios and a brand new Q1 agreement to invest in another OpenRGS partner studio called Jinx Gaming.
It's a totally closed-loop flywheel.
Exactly.
You provide the universal adapter for a new studio to build on. You sit back and watch the back-end analytics to see exactly which studio is making the most engaging games and retaining players.
Right, because you have perfect visibility into their performance.
Exactly. And once you spot the winner, you use your massive profit margins to invest in that specific studio. You provide them capital to grow faster, which in turn brings more volume back into your own platform, while also giving you the corporate upside of their equity growth.
If we connect this to the bigger picture, providing capital and strategic support to these founders effectively locks those top-tier developers into the Hacksaw ecosystem.
It's brilliance.
It ensures that the best new games remain exclusive to their network. And beyond the platform investments, there is a seemingly minor administrative detail in the report that signals their broader long-term ambition.
Oh, the currency thing.
Yeah. Effective January 1st, 2026, Hacksaw officially changed their reporting currency from the Swedish kronor to the euro.
Right, and the report explicitly mentions this is to prepare for future euro-denominated financing.
It might sound like really dry accounting, but it is a highly strategic move. Hacksaw AB is a Swedish company listed on Nasdaq Stockholm. By aligning their financial reporting with the broader European market, they make themselves significantly more attractive to large international institutional investors.
Because those investors might not want to deal with the currency risk of the kroner.
Precisely. Combined with their methodical state-by-state licensing march in the U.S., this currency shift shows a deliberate strategy toward global standardization. They're professionalizing their corporate structure to match the massive global scale of their operations.
So we've built up this narrative of an unstoppable tech juggernaut, right? They have the frictionless 82% margins, the brilliant real estate zoning board model of OpenRGS, the investment flywheel, the global expansion. But, every empire has a vulnerability. And the financial report is legally required to outline exactly what threatens this business model.
Yeah. The risks and uncertainties section of an interim report is always where you find the reality check.
Always.
For Hacksaw, the primary risk identified is pretty blunt. the continuous development of laws and regulations in the gaming industry. Furthermore, they specifically call out income tax risks.
Let's unpack that for a second because they operate internationally across over 35 locally licensed markets, and they rely on independent tax advisors. But the report notes a persistent risk if tax authorities in individual countries make what they call, quote, restrictive interpretations of regulations, or just outright amend the laws.
Yeah, it is the ultimate bottleneck for digital companies trying to operate globally.
Right. I mean, if a single regulatory body in a major jurisdiction wakes up tomorrow and decides to completely change their mind on iGaming tax rates or licensing requirements, does that shiny 82% margin just vanish? Like, can software efficiency actually outrun government bureaucracy in the long term?
This raises an important question, honestly, because operating across 35-plus locally licensed markets creates a fascinating dynamic. It is simultaneously Hacksaw's greatest shield and their greatest vulnerability.
How so?
Well, it's a shield because of geographic diversification. Just like they diversified their game portfolio so they aren't reliant on a single hit game, they are diversifying their regulatory exposure.
Oh, I see.
If one country suddenly passes a highly restrictive law, Hacksaw still has 34 other markets generating revenue. The loss of one jurisdiction won't sink the entire ship.
They aren't putting all their eggs in one regulatory basket, essentially.
Exactly. But the flip side is the vulnerability. Compliance is incredibly expensive, and it is a constantly moving target.
Yeah.
In the digital age, local and national tax authorities are aggressively trying to figure out how to capture revenue from these borderless tech platforms. What Hacksaw delicately refers to as restrictive interpretations essentially means a local government deciding, actually, looking at how your servers route data, we think you owe us significantly more money for the digital transactions happening within our borders.
And when you're dealing with 35 different governments, you are fighting 35 different battles over tax interpretation and compliance.
Right.
That requires localized legal teams, dedicated auditing firms, and constant technical adjustments to stay within local parameters.
The code scales infinitely, but legal compliance does not.
Yep.
Every new market adds an administrative burden.
Mm.
So while their software efficiency is unparalleled, the friction of global bureaucracy is the one physical limitation that can eat away at that 82% margin over time.
Man, that's a lot to process.
Right.
Bringing this all together for your toolkit, what we've seen today in this Q1 2026 report from Hacksaw AB is so much more than just a snapshot of the gambling industry.
Definitely.
It's a masterclass in modern platform economics. They demonstrated the vital importance of transitioning from a creator of individual products to becoming the indispensable infrastructure that other creators rely on.
Yeah, they showed exactly how to utilize extreme operational efficiency, that mind-blowing margin generated by just 275 people to build a massive cash pile.
Mm-hmm.
And then, crucially, how to use that cash to fund and buy equity in the very ecosystem that sustains them, all while aggressively diversifying their risk to escape the one-hit wonder trap.
It is a blueprint for achieving massive scale with a minimal physical footprint. But I want to leave you with a final lingering thought to mull over. As we watch B2B platforms like Hacksaw become the essential, unignorable infrastructure that hosts, funds, and scales the creators in their industry, who really holds the power?
Ooh. It represents a profound shift in market dynamics.
It really does. At what point do the invisible architects of the platform wield more influence over the future of digital entertainment than the operators whose names are actually on the door, or even the players themselves?
Right.
Because when you aren't just the casino, but you are the one designing the digital slot machines, creating the universal adapters, funding the studios that imagine the games, and building the very floor they sit on, you aren't just participating in the industry. You are writing the rules of gravity. Thanks for joining us for this deep dive. We'll see you next time.